So thanks everyone for joining. Today we have Jason Vaughn here from Empire Home Loans, and he's going to talk about some manufactured home financing. So we're really excited to have him on today. So I'm just going to pass the floor right on over to Jason.
Thank you. I appreciate the introduction here. And just to verify, you can see my screen correct, Rachel?
Yep, I can see it perfectly.
Okay, fantastic. So yeah, just jumping right in for those who don't know me. I've been in lending for 15 years. Prior to mortgages, I actually opened and managed 2 offices for a local subprime auto company. During this time, my wife and I bought a duplex using FHA, 3.5% down. We lived in one side, rented out the other side, and then used the equity in that home to actually buy a short-term rental out in Packwood that we use as like an Airbnb, VRBO, have it on all those. And then again, use the equity to buy a third property that we live in now, which also has a detached ADU. So we now have 3 long-term rentals and a short-term rental, all from leveraging that initial $7,000 down on an FHA loan, and have really used no cash out of pocket since then. During that time, I then transitioned into mortgages, as I've always had a passion for the real estate industry. And when it comes to manufactured homes, I've always actually dreamt of owning a manufactured home park myself, as my grandparents lived in them for 20 years, and I always saw the benefit both as affordable housing for people, but also as a great investment tool as well. So jumping into the class a little bit, and also I just want to say, again, I just really want to stress how thankful I am for those that have joined and those who do watch it in the future on YouTube. I know time is the most valuable resource that there is, and it's the one thing that you can't buy back. So again, I thank you everybody for the trust and believing in coming to this class. So a little bit about what we are going to be talking about here is the different types of homes, just to kind of get some terms laid out. HUD code and the importance of that code. And then really the nuts and bolts is going to be the manufactured homes on leased land, or also known as in a park. And then we'll touch a little bit on manufactured homes on their own land as well. And then of course, jump into a quick Q&A section. So why manufactured homes? Well, one, there is a lot of business to be done in the market for that. You can see over here some of the originations on both chattel loans, which I'll get into the definition of that a little bit more, and then also homes on land. And then you can just really kind of see some of the demographics here. But really, a lot of it is helping people with affordable housing, doing that good for the clients in the industry out there, the families that are struggling. But it can also help bring a wider range of clients who don't have the ability to buy a home on land. You also typically have a little less competition because not as many people are willing to work with those customers on the real estate side and on the lender side. And due to helping people in a situation where a lot of people say no, they can be a fantastic referral source as well. So, for example, like my grandparents living in that manufactured home, they ended up referring a lot of family to that, realtors as well. So having that just as an example of a great referral opportunity, but not only the people you're selling to, but also the park managers in that, getting in with them and being able to get more referrals out of that park. And so it can be a great referral source as well. So to kind of go over a little bit of the different names that you may hear thrown around is mobile homes. So mobile is actually pre-June 15th, 1976. That was pre-HUD code. And then manufactured homes are actually anything post June 15th. So there actually is a difference in those words and what they actually mean there. The mobile homes are, since again it's June 15th, 1976, they're no longer being built, and very few will finance them, especially in parks. Manufactured homes, again, those are built to HUD codes, And then the tiny homes and park models, those are kind of the newer things we're starting to see. They're under 400 square foot living area. And you often see one-off builders building them, but then even in the same factories as the manufactured homes, they typically will follow an RV code, not a home code, and can be on wheels or on actual permanent foundation when put somewhere, but again are a bit harder to finance even from the manufactured homes. So bonus for you guys, if you want to actually throw in the comments, what is a modular home? So modular homes, bringing those up, they typically look very similar to just a regular stick-built home, but they're actually built to the state codes instead of a national HUD code. So they really, although they're built in a factory, they're really pretty much indistinguishable from a stick-built home for the most part, and financed just the same as a stick-built home. So HUD manufacturing housing, really, again, that came about in June 15th, 1976. So any home prior to that will not meet HUD, no matter if there's been any modifications or anything to that home. When looking for the homes, this tag you'll see, typically it is riveted to the front of the home, or it may be fastened to the tongue or the corner of the steel frame. This same information should also be able to be found on the data plate, which is like a paper label that usually you find in the interior sidewall of the kitchen sink. So like underneath the kitchen in the cabinet there. And then sometimes you'll also find it in the master bedroom's closet on the wall. And really the codes, it created really standardization for construction safety. They were federally regulated standards, all aspects from construction, design, strength, durability, transport, fire resistant, energy efficiency, really just the whole set of codes being put out there. They've been updated multiple times since then, and things do keep changing, but still that base from 1976. And that doesn't mean that a home built prior to that is a lower quality. It just means it's not has certain standards built in, so they can have more variable there. So financing these homes in a park, there is no traditional financing for these in a park. There won't be, you're not going to see FHA, VA, USDA, conventional, any of that stuff. In fact, they are a non-QM product called a chattel mortgage. A chattel mortgage is a mortgage on a movable item, cars, RVs, manufactured homes, but that's what chattel stands for. So if you do see a pre-approval with FHA, VA, USDA, or conventional, or anything like that, I highly suggest calling the lender and speaking to them. At worst, it means that that lender wasn't aware that it is a home on leased land. Maybe the listing or the buyer's agent didn't provide that information to that lender, or it could be that, and they won't be able to finance that home, or it could be maybe they do finance it because some other lenders are starting to do it, but they haven't done it much. So they may not be fully aware of all the ins and outs. So that's just something I would watch for when those are coming over on that pre-approval. I typically will call the listing agent so they know that our team is familiar with the process. We do these a lot. And again, if they don't call, I'd suggest calling them up front. Again, these homes, they're not traditional real estate. They are actually considered personal property. But really, you do end up having a very similar process, but there are some differences. One of the big things I would always suggest doing is making sure when customers are looking at these and when they're asking about them that they are aware of the space rent, specifically that the space rent is typically not calculated into any type of online payment calculator. So anytime you're looking at Zillow or Redfin and it says the estimated payment for this home is that, whatever that may be, say $1,000, it's not accounting for that $800 space rent. So a lot of customers, unfortunately, do believe that that home overall is going to be a lot less than it is. So that's one of the first things I would jump to and make sure they're aware of that. I have a love-hate relationship with those calculators in Redfin and Zillow, anyways, because of other aspects with defaulting to 20% and whatnot. But I'd always make sure people are aware of that. And we lenders don't escrow the space rent and pay that for them like insurance and taxes typically are. However, we do still have to include it in their debt to income ratios when we are looking at qualifying them. So for the home itself, as I've said a couple times, we are looking at the post June 15th, 1976, having it be an actual manufactured home that way. We can do single wides, doubles, triples, really doesn't matter in regards to that. We can even do homes that have been moved twice. So, moving once is going to the original location that was set up. And then if it's ever been moved from that original location, a lot of companies can't do that. We do have the ability to do that as well. We can't do any investment homes for in a park, but we can do second homes, vacation homes, and whatnot. And then you do need a foundation inspection, tie downs on a home on land, on its own land, but that actually isn't a requirement when we're looking at homes in a park. And even if there are some things here that, if somebody's looking at buying an investment home or, anything like that, and give me a call anyways. We do have other people that we do network work and refer, so we can always help find something for that as well. When looking at the customer themselves and the lending guidelines, minimum is 5% down. A lot of other companies do require 10, 15, 20 at times down payment on these. However, we do have the ability to go at 5% down. And I would say that's the majority of our customers is typically doing 5% down. The big thing to be aware of is there is no down payment assistance program at all that I am aware of anywhere that does these. You're not talking Washington State bond or anything like that. And again, the reason why is going back to the fact that it is not real estate, it is considered personal property. So 5% down is a little higher percentage than, an FHA at 3.5% or conventional at 3% for a first-time home buyer. However, it still typically comes out to a lower dollar amount. So if we're looking at 5% at $100,000, that's $5,000 compared to even at 300,000 at 3.5% for FHA, you're looking at 10,500. So a lot of times you can still have a lower down payment on that, but it does have to come that way. Housing ratio. So, we can look at both housing ratio. Again, this does have to include the space rent and then the debt to income ratio at 48%, including everything else. 600 FICO on the low side, but the thing is it's not just looked at on the FICO itself. So we do have to look at, if it's a baby credit and they've just got one credit card per cap one for 6 months and they've got a 700 score, that may not actually work, even though the score is higher, because unfortunately they do require looking at installment history or rental history. So either 2 years on like a car or rental history on an actual lease agreement. Being, with their mom, paying a couple $100 a month doesn't work, unfortunately. And then no unpaid collections or charge-offs. So any of that would actually have to be paid or removed off credit up front. In some aspects, the lending guidelines can actually be a little tighter than a home on land. And the nice thing about, with us is because we don't just do manufactured homes, we do everything. There's multiple times that we've taken a customer and they may originally be looking at a home in a park, but because they don't realize the down payment, that they have to do that compared to a down payment assistance or some of other things, they may actually qualify and be able to do a home on land, and we can actually switch them into that in a smooth, easy process compared to them having to go apply somewhere else. There are no non-occupant co-signers. So anybody on the loan on title will have to also be a resident of the house. One of the things that is kind of a little different is 2-year job history. they don't require same industry. Somebody can completely switch industries where they're just really looking at a 2-year history there. But the income calculation otherwise is pretty similar when you're looking at things like bonus, commissions, any self-employed income. We're calculating that all very similar to what we would look at on any other traditional loans. And then we don't have the ability to do I-10 borrowers in a park. We can do those for home on land. So another time where, somebody's referred to us for one reason or another, they may not qualify in a park, or maybe just realize that they actually can't get approved for a home on land and they didn't think they could. We can make that an easy, smooth switch right over to that. As I was saying, there are no down payment assistances. Again, it's a thing that I hate, that I've ran into multiple times with like Redfin and Zillow. They'll say on there, here's 8 different down payment assistance programs for. Unfortunately, they don't work for homes in a park, even though they'll have that on there still. Otherwise, pretty similar to mortgages. Traditional mortgages, we got to use verifiable funds. Can't be, mattress money. It's got to be in the bank, seasoned for at least 2 months. One unique thing they can do is actually secured loans. So I've had customers do this before, where they don't have that down payment. Maybe they've got a paid off car, paid off boat, whatever. They can actually get a loan on something else as long as it's a secured loan, and use those funds for the down payment. Now, we do have to be able to know about that, obviously, to be able to account for that in their debt to income to see if that works. But in certain circumstances, it can be a great way to go. But again, it does have to be secured, so it wouldn't be able to just like put it on their credit card or something. Of course, they can do like a 401k withdrawal or loan. Again, we just have to include that in their debt to income calculations. And then they can do 100% gifts. They can have 100% of that done as a gift with no issues on that as well. So if they have any family members, then fantastic. Rates and terms here. So rates do not follow MBS as far as mortgage-backed securities, which makes it so that they're actually significantly more stable for rates. Right now, I'm looking at my rate sheet that we had. It was effective May 12th. So we've had that for over 2 months with the same rate sheet on there. And but they do typically vary a little, very higher, as we can see here. They're talking 7% to up to 10.75. 7% is going to be with 35% down and a 760 credit score. We can go all the way down, as I was saying, to a 600 credit score, and they can do 5% with 600 credit score. There is no requirement of they need more down because of a low credit score or anything like that. Anybody has access to that, unless there's some other underwriting thing that they pull up. I've had one time where the job stability was not very great. They approved it, but required a little higher down. But 10.75%, that is with a 600 FICO with only 5% down. And then tons of differences in between there. We can have the rate bought down by up to 1%, and that can be through the seller or the buyer. The max term being 25 years. But the nice thing is there also is no PMI requirements on these. So even though the rates typically are going to be a little higher, the term is going to be a little shorter with no PMI. Even when factoring in space rent, taxes are typically lower on a manufactured home. Insurance is lower on a manufactured home. A lot of times the payments are still coming in a decent bit less than a comparable home on land. So it really still, even with a bit higher rate, even with the shorter terms, can still be a great affordable option for a lot of customers. Although I was saying that we do have down to 600, that's really kind of their standard program. They do have another option, which is called their bronze program. That goes down to a 550 FICO, but does require that 10% down, and rates are a little higher. The big thing on this though is it actually requires higher closing costs. So on this, there is an additional 3%. That 3%, what that is because we are typically paid by the lender paid compensation. It is actually a borrower paid compensation on that. So it does end up being higher down and higher closing costs. But we've done some of these, and again, in the right circumstance, it can be a great way to go for them. Speaking of closing costs, typically we're looking at about 2 to 5%, and the 5%'s on a cheaper home, so there's certain static costs. I'd really say overall, you're looking somewhere between about 4 to 8,000, depending on prepaids, the taxes and insurance and all that. About 4 to 8,000 for closing costs. The nice thing is the seller can pay 100% of the closing costs, and it's actually pretty common. I've seen that more times than not with the seller paying those closing costs and can pay to do the 1% on the regular program and the borrower paid compensation on the borrower paid compensation. However, again, they can do all of the closing costs, but we do still require that customer to have that minimum of the 5% down, which can be a gift. So we've done multiple transactions where the occupant themselves are putting 0 down, which can be a fantastic way to get into a home. So looking at kind of the loan process from start to finish, we will pre-qualification. And the reason why it's typically a pre-qualification compared to a pre-approval is a pre-approval is done when it's ran through some of our automated underwriting systems. But those systems don't, because it's not a conventional FHA, USDA, all that, they don't work on these homes. We can, other than that, it has to be approved by the lender to have a pre-approval. So typically what we'll do is we'll actually do a pre-qualification up front because their guidelines are pretty simple. From there, the lender doesn't like to do what's called TBD, so address to be determined. They typically need the address. We like to play with that anyways and actually send them an address. Maybe it's a home that they're interested in but don't have a contract, or just a home that's in a similar price range, and have them check over things when needed. We can do that pre-qualification up front, and then also once it's been reviewed by the lender, we can get that pre-approval. These lenders, they are pretty busy. These loans are pretty popular right now, so their turn times up front is typically around 5 days on that pre-approval at times, which is why we like to go ahead and get a pre-qualification. We can get them out shopping and then be able to do a pre-approval if needed at that point. When we are submitting that, are needing information on the property and the home and everything. So we're going to need the address, but we also will want to see the year, make, model, and serial number of the home, along with the park rent, to be able to submit that to them to know from there. And part of the reason why the lender doesn't like to do pre-approvals unless it's on a specific house is because base rent can vary so much. That's one thing I hadn't mentioned, probably should have already, is I've seen space rent as cheap as $400 or $500 in some of the more rural areas, up to as high as $1,300. And that's more like Marysville or stuff like that, in some of the more densely populated areas of these manufactured homes. So it can vary so much. So if they say, oh, well, they can qualify for 100,000, well, they can qualify for 100,000 in one park, and they may qualify for 150 in another park, or 50, depending on that space rent. So what we do is we like to let them know, go over the payment amount and say, maybe like with this base rent, typically looking about $850 as an average. With this base rent, this is how much you qualify in this park. This is how much you qualify, and kind of go from there. The appraisals are done through data comp, and those appraisals can take up to 21 days. So we like to do those as quick as possible. So as soon as we can have that approval from the lender, the credit approval, be that on a previous property or not. We like to get that ordered instead of waiting for like the inspection or anything, because that can just add time to it. If we're looking at 21 days and we wait a week to get the inspection done or anything, now we're looking at 28 days on just having the appraisal back. And then after we do have the appraisal and all the conditions back, gets into the closing department. The closing department orders that tax and flood cert, which goes through the counties and whatnot, and they can take days. So there's nothing that we can do to speed that up, which is why we like to have things done as soon as possible with the appraisal and everything, just so we can get those checked off. The lender does want the originals to fund. Sometimes we can get them to fudge that and just do scan copies and then proof that it's been FedExed. And they have an 11 p.m. cutoff. Or sorry, that is wrong. That's 11 p.m. That should be 11 a.m. cutoff time. My apologies there. But they have a late 11 a.m. cutoff time and then a phone interview on that day of closing. So from once we get that kind of cleared to close, ordering the certs, getting signed, all that, we're often looking at about 5 days, 5 business days for closing. So that's why, stacking these together, we want to just move everything as quick as possible. Because that it really does depend on how busy the market is. When we were looking in November, we were doing appraisals were coming back quicker, and we could easily do a 21-day close because of the market, how busy things is, both the lenders and the appraisals on these. We're seeing these creep up longer and longer, which is why we at this point would suggest a 30 to 45-day close on those, just so everybody's on the same track. And our team, we know how to process these as smoothly as possible, but some of these things, it's just stop and go traffic of the process. So again, ways that you can, help us help you is by not waiting on that inspection to order that appraisal. The appraisal is paid by the customer upfront when ordering. So, having that conversation, that's something we have that conversation as well, is just getting that ordered as quick as possible. The copy of the vehicle title, and one note on that is the seller must be the owner of record on the vehicle title, and the lender will not accept a registration in lieu of that. So if the seller does not have the title, or they just got it signed over to them or something, they are going to need to get that changed for us to be able to do something. So just be aware of that on that. And then just the copy of the title transfer documents that were done up by escrow. Let us know if it is in a flood zone. The lenders will do a lot of different homes in flood zones, but it depends on the zone. And then obviously making sure we have the proper insurance and all of that. Park approvals, the park approval, gotta of course get that from the park manager. Park managers, sometimes they're very hard to get a hold of, very unresponsive. So, and there is a specific form that they have to fill out for the lenders. We've had multiple times that a park manager will just like shoot an email that says they're approved. And that doesn't unfortunately do enough justice. We actually have to have a form filled out. And so having any time, help get that wrangled is very much appreciated. And again, working with the customer, making sure they're aware that we have that phone interview on the day of closing. And, we grab those pay stubs before closing, but just in case, just something to be aware of there. So jumping on to manufactured homes on land. Actually, I'll pause there real quick. Do either of you have any questions on homes in a park before I jump on?
I do not.
Okay, perfect. We'll move on here. And so, as I was saying, manufactured homes on land. I'm not going to go into this nearly as in depth because most people are more familiar with these. We can do traditional financing options, traditional 30-year terms. We've got great wholesale rates on homes on land. And the process is a lot more similar to a stick-built home. On those, we do have non-QM options when needed, when a home doesn't fit some of those typical type of products. And we can finance single wides, double and triple wide homes. along with homes that have been moved, but there is 5% minimum down. So we're not going to be able to do like FHA 3.5% or conventional at 3%, but we do have a portfolio product that will do that at 5% down, compared to otherwise it's just VA doing a home if it's been moved twice. We do also have the ability on the rare chance doing a pre-HUD, so pre-1976 home, as long as it's in a planned urban development or in a condo community. We do have the ability to do those as well. And then just some stuff as far as on the broker side, would love to help out, get more people into homes. I know, every great agent's got their own great, well, that's realtor partner, but that should be lender's partner. So I apologize for that too. But we love being your backup lender. We've got a lot of different options, and we try and, help our partners make more money. Wholesale rates, that means customers qualify for a larger dollar amount, but also more programs. We can do FHA down to 500 FICO. That does require 10% down. We've got DSCR loans, debt service coverage ratio loans. Those are for investors buying rental homes and not even looking at their income, looking at the property's income. A buy before we sell program. Then we really just kind of also work to really help our partners save time and stress by keeping everybody updated in the process and helping work those leads. Then I also love collaborating to educate and empower our clients, teaching classes like this, but also teaching other classes. Just taught a class with a financial counselor about helping customers budget and repair their credit for home ownership. And then also different calculators like a rent versus buy or cost of waiting analysis to kind of help show that customer that it can be a great time to buy still, even with rates higher. Or on the seller side, being able to motivate them to be able to make that step to buy a new home, even though their rates may be going up. And again, just kind of jump into questions and answer section. So if either of you guys have anything there.
I don't really have any questions. I think you covered everything.
Perfect.
Yeah, no, you covered everything. Thank you.
Well, I appreciate it. Thank you. And thank you for the opportunity to do this as well.
You're welcome.
And
yeah, thanks for joining us today, Jason. This is really informative, and I'm sure agents are going to get a lot of benefit from this.
Perfect. Glad to hear it. And obviously, here's all my contact information, so anybody can reach out if they have any questions and be able to help and go from there.
Fantastic.
Awesome. All right.
Well, thank you
thanks
much
again for joining us today.
Yeah.
We look forward to having you again sometime in the future. But yeah, this was really great. So thank you again.
Yeah, I'd love to do anything in the future. Just let me know.
Awesome. All right. Well, everybody have a good rest of your day. And we will see you again next Tuesday.
Perfect. Thank you.
Bye.